Good afternoon and welcome to today's Premier Account Investor Signals Market Update for September 2014. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presenter today, myself, Leon Hine. I'm the current Managing Director of Investor Signals, the investment manager in the Investor Signals model portfolio. I have over 17 years of experience in the financial services industry as a licensed securities and derivatives advisor. The topics for today's presentation: we look at the macro update driving equity markets, we roll through the ASX top 50, we review the FY 14 earnings season, and we look at the FY 2015 portfolio strategy in light of where we see the macro trend and also at an individual company level where we see earnings growth, and we conclude with a short-term Australian market outlook. The Investor Signal service is centred around a premium account where we manage a model of portfolio of ASX top 50 stocks. We utilise the benefit of call options to enhance portfolio returns. We're focused on effective ownership around ex-dividend dates and generating above average cash flow as well as allowing for some capital growth. It's managed in a strict investment mandate which is suitable for self-managed super funds, and the assets will remain in your name. If you'd like to know more about the Investor Signals Premier Account service, please contact me, leon@investorsignals.com, or using the details there on screen. Moving straight into a graph tonight of the Australian market to start with, and then I'll come back and we'll look at the US market and in particular the 10-year treasuries. So for those that have been Investor Signals clients or followed the recordings for the last 4 years or so, you would know that I've been an adamant bull and we've been aggressive buyers of the market on any pullback. From a stepping back and looking at a real macro perspective, I think that equity markets maybe have 5 to 6% upside before they would run into a valuation argument where I just don't think that they could trade too much higher short term. And I guess we then compare that with, well, what are the risks to the downside? And I still maintain that there's about 10% risk in equities to the downside, and that's really as a result of US earnings not coming through, and I'll get to that a little bit more in the moment. So when you look at the XJO trading about 15 times earnings, we delivered roughly around 7% earnings growth this season, and on a forward outlook basis the expectation is that that'll increase closer to 10% next year. Now a big part of that is dependent on the commodity names improving, so spot iron ore prices as an example would have to rally back to around 100 to 110 a tonne for that to really play out on an average. So as I roll through the top 50 stocks, we'll look at it from an individual perspective. But before we do that, maybe let's just jump into the US market. So up on screen there's a graph of the Dow Jones, and I've spoken about this from a valuation perspective. When you look at the S&P 500 earnings delivering about $30 of earnings per share per quarter, at about $120 of earnings on an annualized basis, with the S&P trading on forward earnings up at around 16.5 times, you know, arguably it's expensive. It's trading a little bit above the historical average. Obviously, the flip side to that argument is global bond yields remain very low. Therefore, you'd expect PEs to be slightly higher. However, that's still dependent on 8% earnings growth coming through. If S&P 500 companies over the next 6 months, the market forms a view that they're going to struggle to deliver that 8% earnings growth, then really fair value for the market is back down here at around 15,500 on the Dow. Again, from an upside perspective, I think again the US market could put on 5 to 6%, but I think on balance the risks are starting to increase that, whereas maybe this was something in the order of a 10 to 20% probability, I think it's now starting to increase maybe up to a 30% to 40% probability. Certainly when we were to be trading, say, 18,000 on the Dow, I think it really starts to get more of a balanced 50-50 probability of the market having some sort of 10% correction, especially if we were to simply sort of drive up to that level over the coming weeks. But again, I think there's an argument that in light of the fact that we have weak data out of Japan, and for the June quarter we saw the Japanese economy contract about 1.7%, so on an annualized basis that's getting close to 7% contraction there. We've seen very weak manufacturing data out of Germany. We've got problems in the bulk of the Eurozone with not delivering positive earnings growth or economic growth. We've got very low inflation in most parts of the world, especially in the Eurozone, especially in the US. Even to some extent we're seeing the inflation moderate in China, and in line with that we've seen weak manufacturing data out of China as well. We're obviously seeing negative housing data month on month, so that trend hasn't improved in China from the housing, whether it be from a construction standpoint or whether it be from a pricing power, where we're seeing effectively the marketing level or prices of these residential complexes come down month after month. And I think ultimately that there's starting to be risks developing in the global economy that I think make it pretty difficult for the S&P 500 to be guaranteed that they grow earnings at 8%. So on balance, I think, especially coming into the month of September, it's often a period where volatility increases. I just think there's an argument that makes sense to start to try to sit on around 20 to 30% cash just over the next maybe 4 to 6 weeks. Still keep exposure, still have 70% of the portfolio long in equities, but we really start to review those names and have a think about where that earnings concentration is of those companies and try to position a portfolio so it provides a little bit more defensiveness in the weeks and months ahead. And here's one of the leading indicators that I think is a bit of a concern. So for all the headline risk that we see in the media about the US Federal Reserve raising rates and when they raise rates the share market's going to correct, well, the reality is the bond market's telling us that that's not going to happen. This is the yield on the 10-year treasuries. We've seen very weak growth in the US during the March quarter, and it picked up substantially in the June quarter to a pace that on an annualized basis the US GDP is growing somewhere around sort of 3.5% to 4%, which are very strong numbers. But if we were to see that fall off again in, say, the September quarter, and then again in the December quarter off the back of this weaker global demand picture, as I've spoken about with Japan, China, Eurozone, the risk is that I think that, again, that earnings growth and the multiple that's been assigned to the S&P 500 company starts to come under pressure. And for that reason, I think, for the first time in probably 4 years, my argument is that, probably now's the time to be sitting on a little bit extra cash than you otherwise would do, but certainly keeping exposure to the equity market through the remaining sort of 70% of the portfolio and trying to benefit from what I think is a pretty marginal move from here, maybe another 5 to 6% upside before you would think that we run into some type of valuation issue, irrespective of whether earnings do continue to sort of meet that target of around 8%. So on that note, let's move straight into the top 50 stocks. And I'll roll through these and cover a bit of a summary following earnings season. So AGK trades now on about a 4.5% dividend yield. We've seen the company do a rights issue at $11 to help pay for the Macquarie Generation assets that they've bought. I think down here the stock starts to look good value. We're participating in the rights issue, so if you have cash available in your account and you want to take up that rights offer, that's something that you can do. And if you want to chat with me further about that, please contact me. But otherwise, AGK, not much in the way of earnings growth. Disappointed the market a little bit this earnings season, but I think there's an expectation that it finds support down here, trades back up to around 14.50. We've just collected the dividend today in AGK of around 33 cents. Asiano, again, this is a story about the company being very disciplined on controlling costs and continuing to sort of drive earnings growth through ongoing cost-cutting program. We were always of the view that it was good value down here at around 5.20. Up here, I think it's pretty marginal. We sort of skip past this one, and I suppose I just note that it trades on a dividend yield now of around about 2.75%. On a forward basis, that creeps up, allowing for the fact that the company's going to increase their dividend payout ratio, getting up to around 3%. I think it's close to full value here. Amcor was one of the standout results of the season. We're looking for around 8 to 9% earnings growth. The company delivered that. The company's gone ex-dividend today, roughly 23.5 cents. On a forward outlook, I think Amcor can continue to deliver 8 to 10% earnings growth. Therefore, it's a name that we want to own. But at these levels, if we're looking around portfolios and trying to say where can we trim some cash, I think the probability of Amcor trading materially above 11.50 is pretty limited. So I think it's probably bumped sideways at or near this level. So if we can sort of turn that into cash, given that we don't think there's a lot more upside short term in it, and we are to get the benefit of the market correcting, then we can buy back into Amcor or other assets at more attractive prices, and I'll highlight some of those as I roll through today's recording. That's the type of thing that we're looking at the moment in the market. AMP continues to impress the market with recovering earnings. From a forward outlook, the stock trades on about a 4.5% dividend yield, is trading on a very high PE, and it's dependent for those earnings growth to continue to come through. ANZ, interesting here with the banking space. My broad view has been that they grow earnings somewhere around 5%. You need to strip out the re-provisioning of bad loans that are added back into the earnings that make the headlines numbers look more attractive. In the case of ANZ, there was certainly some concern around the first half 14 compared to the second half 14. So there was no revenue growth in ANZ from sort of the front half of 2014 to the back half. I think what that probably starts to tell us is even if they do have underlying cost growth of around 2%, the probability of them substantially growing earnings in the short term, we know they're not likely to raise their dividend payout ratio any further. I think the argument is this sort of super regional Asian strategy that they're running in light of sort of some of the risks that are emerging in China. I just think there's a question mark as to whether ANZ's the bank that you want exposure to, rather than maybe Westpac is probably our preferred banking stock. So right at this point in time, if we're sitting on profit in ANZ, we're looking to lock some of that in, maybe just keep some moderate banking exposure, but really start to look elsewhere in the market for value that maybe doesn't give us that same risk short term, given the data flow that's coming out of China at present. ASX goes ex-dividend tomorrow, roughly 89 cents. So ASX probably is a company that should continue to deliver earnings, all things being equal, about 5 to 7% earnings per share. I think up here from a valuation standpoint, the stock's trading about 19 times earnings on less than a 5% dividend yield. So one would think that, yes, you've got a lot of capital running into these names ahead of the dividends, but post the dividend, I think it's probably pretty close to its resistance. And again, it's either a name that we look to trim and take profits on, or for clients that already sitting on reasonable levels of cash, happy just to sell covered calls over ASX. This is a name that we own at lower levels here, and again we either look at taking some profit up here or capping it out at or near sort of this $38 level, as I think sort of the probability of it compressing much below a 4.5% dividend yield, already trading sort of 18, 19 times earnings. Again, I think the argument is it's pretty close to full value. AZJ, interesting here. Look, I'd always warned on this that the market was looking for about 20% earnings growth in FY14. That's come through at about 13% earnings growth. I think a large part of this adjustment's probably starting to play out. Down here at around this sort of level, I think it's a fairly high conviction buying opportunity. And again, any sort of ongoing sell-off down at this 450 level, I think we become pretty aggressive buyers of AZJ. BHP, so obviously you would have heard in the news the split of effectively the iron ore petroleum business away from the other commodities. Nuco, which will be those other commodities, will pay roughly around a 5.5% dividend yield, have a market cap of around $20 billion. We think that the BHP really is a story going forward of iron ore and petroleum. We think Rio's a story of iron ore and aluminium. So it really becomes an argument of, out of the two, you're getting iron ore exposure in both names. It's really an argument of, do you prefer petroleum over aluminium, and if so, BHP is the place to be. And that's our base case. We think that sort of that petroleum energy, and to put this into perspective, the new BHP iron ore and petroleum will represent roughly 80% of EBIT, or earnings before interest and tax. So it's the bulk of the business. From a valuation standpoint, I think BHP is attractive. We're in favour of this spin-off. I think it unlocks value for shareholders. We'll reassess sort of post the spin-off whether we want to keep exposure to both businesses, but certainly as a minimum, some exposure here to BHP continues to make sense. We're trying to sell covered calls up here around this $39 level. I think that caps the upside. From a dividend standpoint, BHP goes ex-dividend tomorrow, pays roughly 66 cents. Brambles delivered in line, about 5 to 7% earnings growth. Up here, the stock is pretty expensive, trading about 19 times earnings, 3% dividend yield. This was a high conviction buy for us down here at around $9. Anywhere, as I've mentioned in the past, from sort of $9.75 to $10, I think the stock starts to look expensive, and you want to be selling those covered calls to sort of complement that dividend income, driving the cash flow up to around 10%. CBA won't pay its next dividend until February. With all the banking stocks largely the same, in line with our view of the market, we think, yes, we could see another 5% push higher, but the increases of risk to the downside are starting to emerge off the back of this weaker global manufacturing and GDP data that we're seeing. And I think for that reason it justifies some level of cautiousness. But again, within the Australian banking sector, our preference is Westpac first. Look, NAB's probably a better leverage recovery play, CBA a little more defensive, and then ANZ is essentially our list of the way we view the banking stocks. CBA delivered earnings results that slightly exceeded market expectation, and obviously a good dividend there. Coca-Cola paid out roughly 20 cents of earnings per share in dividends. The EPS of the company was tracking a little bit above that. The really key here for Coca-Cola is, are they able to deliver an effective cost-cutting program and stabilise the business? From a technical standpoint, we'd like to see the stock break through this sort of 920 level. You can see on screen here we have a price target that the stock will recover back to around $10.50 to $11. Short term, we're simply looking for it to trade back up around this 945 to 950 level, and then we'd look to sell the covered calls into our price range there to sort of drive that cash flow from the ongoing dividend. So I'll expect to collect 20 cents again in that March dividend, and if we can complement that with another 20 or 30 cents of income off that a covered call option, then it starts to sort of justify waiting for the recovery there in Coca-Cola. Computershare, the market was looking for about 10% earnings growth. The disappointment here was the forward outlook statement. The company essentially delivered on the FY14 result, but on a forward guidance they've moderated that a little back to 5% earnings growth. From a dividend perspective, the stock's on about a 2.5% dividend yield. I think this is a name that becomes interesting. If we do get a little bit of a sell-off in the market, an opportunity came up to buy Computershare sort of sub $12, I think there's an opportunity to pick it up at that price and probably make close to 10% on a fairly quick bounce. Generally, the strong equity periods for the market, if you look at it, September's often a period of volatility. Normally from November through to January, equity markets are fairly strong. So if we can kind of position or at least provide some level of cash in portfolios to benefit from the potential of that sort of seasonality play playing out again this year. So Computershare is a name that we would certainly look to add to portfolios. It's been on the watch list. I'd highlighted that it was just too expensive for us up at these levels, but at around $11.50 to $12, very keen to have another look at it. CSL delivered one of the standout earnings, around 11% EPS growth. That delivered about $1.3 billion of earnings. The company's guided to the fact that they should continue to deliver something in the high single to low double-digit earnings growth. The real story here is the company's concluding their current $900 million buyback, and there's a high probability they'll announce another one. But again, to put some valuations around this, CSL trades now at about 25 times earnings on less than a 2% dividend yield onto forward earnings. So even if we go out to next year and allow for the company growing earnings about 10%, trades on about a 1.8% dividend yield. So there's a lot of euphoria around CSL at the moment, and rightfully so. It was one of the sort of standout earnings result, and combine that with the ongoing share buyback, the stock should be well supported. But for my money, I'm of the view that it's getting pretty close to resistance short term. I'd be looking for the stock to consolidate, move sideways, and then we'll certainly be ready to take another look at CSL. Crown, a little bit disappointing here, and I think this is maybe somewhat a reflection of the expectation of Crown having to have larger capital expenditure over the coming years, slightly slower earnings revenue coming through from Macau. Look, whether that has that downside risk to 1350 like I have on screen there, we'll wait and see. Look, from a pure technical standpoint, I just flagged that sort of one of the first times for a while we've seen price break down, create sort of a lower low, volume pick up here on the highs. Often that'll be associated with sort of a down movement in the stock. So it'll be interesting to just revisit Crown over the next 2 or 3 months. On the reverse side, if the price was to break back up through that 1650 level, I think the argument is that the short trades probably come to an end. Fortescue here, from a production standpoint, the company delivered and did everything that it needed to. Obviously, the spot iron ore prices at sub $90 is not doing anything here. Really, the story here is, do you think this sort of second wave of selling in the iron ore price has ran its course? Again, for our money, our preference is to stay focused on BHP. I just highlight again from a technical standpoint that the stock's sort of got these lower lows, lower highs structures. Volume picked up on the high there at around this sort of $5 level. So it's probably moving a little bit lower and would remain under pressure. If we see it trade back above sort of this downward resistance line here, again, maybe the short trades come to an end, but not doing anything there in portfolios on Fortescue. Goodman Group, standout of the property sector, delivering about 8% earnings growth. This was always a good business, and I'd highlighted that it had probably the fastest growing earnings out of any of the property plays. But again, to put this into perspective, the stock's now trading on less than a 4% dividend yield, trading about 16 times earnings. Very expensive, a lot of money chasing yield. Does it come to an end? Probably not, but at some point you'd have to say that this consolidates and moves sideways. GPT, good result here, delivered around 3 to 4% earnings growth. The company's guided towards similar numbers in FY15. Again, with the stock trading on a better yield than Goodman Group, but nevertheless at around 5% dividend yield, about 3% earnings growth, close to an earnings per share rate of around sort of 28 cents. I think that the stock's reasonably full value, looking for a consolidation, and then happy to participate in GPT again. To the extent that we own it in some portfolios, I still think sort of selling that covered call around the 410 level makes sense there in GPT. IAG, great insurance margins in their earnings result, almost double that of sort of QBE. Not quite as good as Suncorp's insurance margins, but IAG trading on a PE of around 15 times earnings on a 4.5% dividend yield. Again, had a great run. We've seen a lot of money come out of the banking sector actually into some of these insurance names. And we continue to like IAG. Iluka, other than to flag, which I made comment on, certainly the earnings results were nothing spectacular here, but the CEO's again guided towards the fact that he thinks that maybe seeing sort of some cyclical pickup in the mineral sands. Whether that flows through to uptick in earnings over the next year or two, we'll have to wait and see. And I've just flagged that on the watch list to say, look, maybe there's some value beginning to emerge here. IPL was one of our high conviction buys, so down here around 270, we're strong advocates of IPL. I think it can trade up to around this 330 level into the end of the year. Probably not much too much beyond that, but I think on a 2 to 3 year outlook, IPL is a stock that you want to have exposure to in your portfolio. James Hardie, look, interesting, given the exposure into the US property sector, the market was looking for a pretty strong set of numbers here out of James Hardie. The CEO commented that the operating environment both in the US and Australia has improved relative to the same time last year, but the US market's recovering more modestly than we assumed at the beginning of the year. Look, the price has adjusted probably to reflect that. We've seen it come back from 15.20 down to around 12.90. Again, somewhere around this 12.50 level, probably an opportunity to have another look at it. I've flagged it up here as a potential high conviction call. We'll keep an eye on that in the coming recordings. Lendlease. So the Lendlease, interesting that paid a strong dividend. The underlying business, if you strip out the benefits that they achieved through the sale of the Bluewater project in the UK, the company delivered contracting earnings in most segments of its business. FY 15 net profit after tax has been guided to around 600 million. Again, with the stock sort of trading on a high PE up at around sort of 15 times earnings on a 3% dividend yield, I think the argument is the stock's running into some resistance up here. So again, where we're sitting on profit here in Lendlease, we've taken the opportunity to sort of trim that and use that as a contribution towards our target of getting around 20 to 30% of cash back into portfolios. From a forward outlook perspective, the company has reiterated that they're likely to grow earnings in those double-digit level. Mirvac, look, for all the optimism around the property sector, Mirvac only delivered about 3% underlying earnings growth. I don't think there's a lot there that changes in the next 6 to 12 months. So whilst I think sort of the underlying trend supports Mirvac, the probability of it really shooting the lights out on the upside I think is a little bit limited. Macquarie, I've spoken about this at $60. I was a bit concerned that the company was just getting too expensive. It was priced for perfection. The first half result, disappointed. The comments out of management that they'll make that up in the second half, I think just puts the business under further pressure. Unless the second half can deliver the growth that's needed to justify sort of that 20% earnings per share growth that the market's priced in, I think that the prospect of it setting up for disappointment starts to increase. And I think in that environment, really what we're saying there is all things going well, the stock can recover to $61, but certainly in the absence of that occurring, I think it could equally be back down here at $51 or $52 quite easily. So for us, look, we're interested that some value is starting to emerge, but again, the risk is that essentially, again, it's still priced for perfection that Macquarie has to come through and deliver a much stronger second half than they did in the first half. And now from a valuation standpoint, the stock trades about 19 times earnings on about a 4.5% dividend yield. But yet certainly that's our concern. Now NAB, interesting within the banking sector, we're seeing the market was looking for an outcome in the UK banking division and a spin-off of the assets there. What we've actually seen is a rationalisation of some of the US assets. But I think this will be an ongoing theme in NAB where they start to clean up the balance sheet and offload some of their non-core Australian assets, and that will help to unlock value. But really at an underlying business growth point of view, again, it's pretty marginal, maybe somewhere between 3 to 5%. They're already at the top end of the dividend payout ratio. So I think owning these banking names, combine that with the fact that we think there's probably only 5 to 6% upside in the actual equity market before it runs into valuation levels, and we've got this increasing risk of sort of the global trade picture deteriorating. I think on balance, again, it feeds into this view that it makes sense to de-risk portfolios a little bit at present. Newcrest Mining there, so no dividend, about $130 million of free cash flow, so that was a little bit better than the market expected. The production numbers looked okay. They're trending back up towards 2.2 to 2.4 million ounces of gold. There's two aspects of Newcrest doing better than what it has. One is inflation picks up. I don't think we're seeing evidence of that. I think probably more the concern is that is central bank policy and this stimulus going to deliver the economic growth that it needs to. Certainly the argument is the US has worked, and it's worked very well. The ECB need to do a lot more. Japan's been doing a lot of stimulus, and we've seen the economy contract in the June quarter. So in an environment where Western economies continue to print a lot of money and provide this stimulus, there's an argument there that gold can still benefit even in a non-inflationary environment as a result of the sort of indebtedness of Western economies or developed economies, I should say, and the and the prospect of them having to continue to provide stimulus to underpin their growth in their economies. And in that environment, maybe gold can trade back up to sort of 13 to 1500 an ounce. Newcrest could recover sort of up to around that $17 to $18. Certainly what's on our radar at the moment is if we get a sense that gold is going to trade back towards that 1500 level, we start to look at the probability of maybe running a stock repair on Newcrest somewhere within that range of sort of $14 to $17 to get sort of maximum benefit out of any short-term recovery there that we see in Newcrest. But yeah, there's the beginning of some positive signs there. The company is still one of the lowest cost gold producers in the world, and mine production is starting to pick back up again. Origin, so this has been one of the standout performers. We own it at lower levels. We've had a target up here at around $16, so to the extent that we've sold covered calls, we went out into the early part of the new year and sold the calls at around $16. We're getting an effective exit price there at around $16.50. Now, the rally in Origins probably happened a little bit earlier than I'd anticipated. I always had the view that around this $13.50 level was the time to add Origin to portfolios. The fact that it's rallied back so quickly is really a function of the stronger dividend outlook policy that the company is implementing, and really the market positioning around the increased revenues that will come through from their LNG projects over the course of the next sort of 2 to 3 years. It really starts to make a material impact on Origin's earnings. And I had alluded to that in 2015 and 16, I expect Origin to re-rate up to around $17 to $18. I just probably would be surprised to see it rally to those levels off this move. I'd expect it to run into some resistance around where it is at present, and then bump sideways. But certainly, you know, from this is not a 2014 earnings story here with Origin. The earnings result actually was not that impressive. It actually disappointed a little, but certainly the forward outlook statement and the expectation of increased cash return to shareholders bodes well for Origin. Not doing there in Orica. Oil Search delivered a good result. We're seeing increased revenues coming through from the PNG LNG projects that they're exposed to, and I think sort of really at these levels Oil Search is fairly full value. We're keen buyers of it on any pullback. QBE, the company, disappointed earnings season, weak insurance margins, are starting to strengthen their balance sheet. Ramsay Health Care, off our high conviction sort of buy here around 45, start to sort of form a view up here at 52. It's getting a little bit expensive. Rio, a little too early for us to sort of look at Rio, just given that we're concerned about some of this data coming through from China. BHP is still the preference. SCG, I think maybe time to look at taking some profit here. I think the risks around ultimately the price achieved for the sell down or the spin-off of the New Zealand property assets, I think at around $3.50 it represents pretty full value. Stockland delivered about 6% underlying earnings growth, forecast to continue to grow earnings at about 6 to 8%. 24 cents a dividend per share. We'll see that increase to maybe around 25 to 25.5 cents next year. The stock can support this price up here around 4.20, but I wouldn't think too much above that. Sonic Health pays its dividend on the 5th of September. It'll go ex 40 cents. As far as its current earnings result, delivered about 5 to 6% earnings growth, forecast similar numbers into 2015. I think the stock can perform well coming into the dividend, but around this 17.50 level is where fair value is. And to the extent that we own it at lower levels, when the stock rallied up to here, we took the opportunity to sell the covered calls up at around 18.50, which again drives the cash flow from sort of 4% dividend yield up closer to 10%. And I think this is one of those assets that I'm pretty comfortable holding in portfolios, even in light of our view that the risks are increasing from a global macro perspective. With this volatility or slowdown in some of the economic data there, I think the probability of that actually coming through and substantially impacting Sonic's earnings is pretty limited. Santos, so we own this. This is one of the high conviction buys at lower levels. We've been riding this rally up here, somewhere at around this $15 level short term. I think starts to look pretty sort of full value. The dividend, whilst it was increased, probably didn't quite meet sort of some of the bullish expectations. Santos paid a 20-cent dividend, puts the stock on about a 3% dividend yield. But again, a little like Origin, the forward earnings growth that's likely to come through from Santos over the next couple of years should see an increase to that dividend going forward, and I think sort of somewhere consolidation here around $15. We're probably ready to have another look at generally Woodside, Oil Search, Santos, Origin. I think they need to make up a fairly substantial part of portfolios. I think that's a sector that can continue to do well over the next 2 to 3 years. Suncorp, great insurance margins, the capital return to shareholders, increased in dividends, and probably more of that to come as a general theme for Suncorp. Sydney Airports has been a strong utility and good defensive yield play. Sydney Airports, not really something that we're adding in portfolios. We've predominantly been focused around Transurban rather than Sydney Airports, and to that extent Transurban up here delivered good earnings result. Over the next 12 months, we'd expect to see sort of that dividend increase up to around 40 cents a share, somewhere between 38 and 40 cents a share, puts the stock on about a 4.5% forward dividend yield. So up here at around $8, I think it can sustain these levels, but arguably getting sort of close to sort of full value. Are we likely to see it compress under a 4% dividend yield? I'd probably think not. You may get a little push higher, but somewhere around this $8 is probably where I think it starts to stabilise over the next 6 months. Telstra, great earnings result here, good growth in the mobile division, slower decline in the old fixed line or copper network. We continue to like Telstra. We've collected the 15-cent dividend. We're waiting for the stock to rally back up. For clients where we haven't sold covered calls yet, we'll look to sort of cap Telstra going forward. I think the argument here, though, is in some ways the mobile business grew slower in the second half than it did in the first half, and can that sort of lead to earnings growth over the next 12 months that's much beyond sort of low single digit, sort of 3 to 5% earnings growth. From a yield perspective, Telstra trades still at about a 5.25% dividend yield. So yes, it could compress down a little bit further to 4.5. So it's a name that we want to keep exposure to. And a little like Sonic, I think Telstra obviously is a defensive name, even in light of us sort of lighting up the allocations and increasing the exposure to cash. I think there's an argument that Telstra should continue to make up part of portfolio allocations. Toll Holdings delivered a better result than the market expected. The market was looking for pretty flat earnings numbers out of Toll. They grew earnings at about 5%. So we were buyers of it sort of down here around this $5 level. We've just collected the recent dividend and we've sold the covered calls as well. Up here around sort of $6 I think is reasonably full value. I don't see it doing too much more than that short term. Westpac's our preferred banking exposure, trading on about a 5.5% dividend yield, looking for about $2.40 of earnings per share in 2015. The company will pay out about $1.90 of that in dividends. I think this is our preferred banking exposure going forward. Wesfarmers, and we've been overweight. Whereas up here at around $45, we started to take profit, even in light of the fact that the company announced a 10-cent special dividend plus $1 capital return. I think fair value for the stock's back here at around $43. That puts it on a PE still up at around 20 times earnings and a 4.5% dividend yield. So I'd expect it to sort of consolidate and move sideways. So we want to continue owning WES and selling the covered calls, but I don't see it doing too much from a capital growth perspective. I think it bumps sideways at or near these levels. WFD, definitely the preferred property play. I think these will grow earnings 3 to 5%, and it's the property exposure that we're overweight to in portfolios. Not doing it there in Worley's at the moment, so we'll revisit this if we see it break up through that 1850 level. Woolworths delivered about 6% earnings growth, so they guided towards a range, I think, between 4 to 7% earnings growth. They've essentially come in just under 6%. The loss in the home hardware division there, whilst on the surface 170 million seems substantial, I think it's a pretty low-cost investment opportunity for them to get in there and compete with Bunnings. So I don't make too much of sort of some of the negativity that surrounds their master strategy. From a valuation standpoint, I've always argued that around this 35.50 is about fair value, but you certainly need to be selling covered calls over Woolworths with a stock trading on a 4% dividend yield at 19 times earnings. There's not much in the way of capital growth. I think it really bumps sideways, but if we can sell those covered calls, drive the cash flow up to 10%, and again, I think this is a defensive name that is okay to have in portfolios in line with our view on that macro picture that's unfolding. Woodside Petroleum fits in with our theme that the oil and gas still makes sense. We've really had, as a broad strategy, we've taken profit on Woodside Petroleum. We tend to be focused more on Santos, but given that Woodside's on an attractive yield of around 5.5%, we're continuing to see good production numbers come through from the Pluto project. I think sort of Woodside stays at these elevated levels, and then there we are back to the main index. So just to conclude today's recording, and there was obviously a lot to get through given that we've had the earnings season wrap up. We've got sort of some of these changes in the global macro conditions that need to be commented on, and where does that leave us from a portfolio strategy perspective. So again, I think the aim is to trim profits where possible. We certainly want to keep about 70% exposure to ongoing equity market value appreciation, but I do think we're within probably 5 to 6% of the market running into resistance regardless. The key becomes asset allocation. Can we sort of keep names in the portfolio like Telstra, pick off some value where we see it, AGK, Computershare, keep some exposure to the banking sector through maybe Westpac. We want to keep exposure to BHP. The oil and gas sector still looks interesting. Some of the industrial names, Brambles looks okay, but we definitely need to be selling tight covered calls over it. Amcor looks okay, but we'd certainly like to be picking that up again on a pullback somewhere around sort of 1070. But a lot of these names definitely require the covered call strategy to complement the returns out of the assets, given that they are trading on very high multiples and these dividend yields are compressing, and we've got this backdrop of sort of slower global growth in all parts of the world, really with the exception of America. And I just question how long the S&P 500 companies can continue to deliver earnings growth in an environment where the other parts of the world have struggled. So I think that's the sort of theme to keep an eye out for over the next sort of 3 to 4 months. Thank you for listening in, and if you'd like to chat further about the premium account service, please contact me using the details on screen.